What's up, Outliers? Happy Friday. Today's session is going to be, as you know, our Friday streams are always options trading for beginners, basics, things themed for newer traders to come in, get your feet wet, ask questions. So this is designed to be interactive by its nature. And the conversation today is going to break down the differences between buying versus selling options. So at the end of this, you should walk away with a couple very key details. One, you should have a theoretical understanding of what the main impacts are when buying or selling options and how those relate to one another. And the part that I'm most interested in is by the end of the video, or the stream, I should say, you guys will have a decision-making framework started so that you can make better decisions when it comes to making the choice between buying or selling an option. So that's what we're going to hit today. Now, to begin, I have a quiz that I'm going to give us. And actually, the quiz is provided by Gemini. I asked it to help out, and I actually didn't know this. It made a built-in quiz for us. So I'm going to zoom this in so it's a little easier for you to see. And what I want us to do is literally take this quiz together. So in the chat, as we read these, throw in your answer, and then whichever answer occurs the most, that's what we'll put, and we'll see how well we do. So the prompt for context that I gave Gemini is that essentially make a quiz for the stream that I'm going to do with my community to test the knowledge of buying versus selling options. So I haven't gone through this. I literally have no idea what's in here. So we're going to do it together. So let's jump right off. So moan commensurate. I have to be honest. Moan commensurate. They say, does your beard contain the secret of life? I'm still trying to figure life out myself and what I want to do when I grow up. So that one less so, but I did read your name originally as Moan Commando, which I really liked. So Moan Commensurate, I guess, is fine, but in my mind, Moan Commando is just so much better, so that's what I'm going to read it as. And then we also got Chop, and then Lauren. Great to see you all. So let's get started. So Lauren says D for the first one. What do you guys say? It says an option buyer has the blank to exercise a contract, while the seller has a blank to fulfill the contract if assigned. And they actually did you kind of a favor in terms of the language that they used here. They phrased this question much more friendly than I would. So any other guesses? We have D so far, and I'll keep it moving pretty quickly. So I'll give you guys, I don't know what the lag is between when you guys hear me and when you're able to type in. How long is the lag for you guys? So if I say time now, how long does it take for you guys to hear when I just said time now? Just so I understand the delay a little bit. Type 1. Okay, so it's maybe 3-4 seconds. Got it. Thank you, guys. So far we have D. Let's see. Wow, this is incredible. The fact that this pops up, says it's right, that it gives you an explanation. This is impressive. Like I said, I haven't looked at this yet. I literally just threw this together for this. This is sick though. Okay. What is the primary motivation for an investor to sell a cash secured put option? Hedge an existing long stock position against a potential drop, bet on a sharp decline in the underlying, generate income from the premium and potentially acquire the stock at a lower effective price to profit from a significant increase in the underlying stock price. What do you guys think? ABCD. And this one's kind of interesting because I actually don't agree with what the right answer is. I can already tell what Gemini is saying the right answer is, but I absolutely don't agree with it. Lauren says C. Sheet says C. And I believe you guys will be correct. So what's my issue with this? I already told you that I personally don't think that this is actually fully correct. So for those that can tell me why do I say that? Why do I say that there is very, very clearly something in here that doesn't make sense? E. Hodge says too vague. Not necessarily. I don't think it's too vague. I actually would argue the opposite. I would argue that this is wrong. This is too specific. So potentially acquire the stock at a lower effective price. That's completely fine. That would have been fine as an answer by itself. That's okay. So it's not saying, and to Lauren, to counter your point, you're saying buying a stock at a low price, you could be buying a crap stock. That's not actually a deal. This isn't necessarily saying whether you get it at a good price or not. It's just saying at a lower effective price, which is completely accurate. So it's less to do with those elements. And the issue, like, this is fine. If they wrote just this, I'm cool with it. The issue that I have with this is this idea of generating income. There's nothing specific about this position that generates income. This is actually a really, really common misconception when it comes to short premium or short option strategies, is people associate it with income because you collect a credit. And this is when people fail to adapt their mindset to fit what we're actually doing in the market. So that's the issue with this. That's, in my opinion, completely wrong. I absolutely would not frame that way in any capacity, but otherwise still okay. So let's continue. The next one says an investor buys a call option with a strike price of $50 for a premium of $3. What is the break even for this position at expiration? This is a good question. This is a really solid, standard, fundamental options trading question. So is it 53, 53, or 47? Who can hook your boy up with an answer? Who knows? I actually like this one because this is like sound fundamentals of options. Chop says 53. So we have one vote so far for this one. Anybody else? Try to give you guys an opportunity to check it out yourselves. Sheet says C. That is 2 here. Any others? Okay. So this is correct. Now, there's a really, really important element here. Lauren says B. Damn it, Lauren, you should have just kept it G and kept it low key on that one. So, Lauren, let's go back to fundamentals. And also, by the way, everybody should give a shout out to Lauren because Lauren is fucking fearless when we do this stuff together, which is great because the fact that she's fearless in trying to answer this stuff and participate, it literally gives great information and examples for literally everybody else. So this is a great, great scenario for us to work through really quick together. So let's talk about the game of buying options. So we can buy calls or we can buy puts. If we buy a call, there's a break-even point, and this break-even point is different at two different places. The break-even point is different at today compared to expiry. This is one of the most common misunderstandings when it comes to buying options. Most people that are newer to options, like if we were to pop on Reddit right now and say, hey, what's my break even if I buy a call? Like this exact scenario. If I said this exact scenario, I said, what's my break even? And I got rid of this, most people would default and give me the at expiration response, which is not inherently the correct response because there's two. There is today versus at expiration. Why is that? Let me draw a hockey stick diagram. So this is the 0 line, and a long call will look like this. Pretend that this is flat, this one here. So a long call will look like that, and then it will look like this. And let's say, not quite like that. That's close enough. So let's say that your break even today is here, and then your break even at expiry is here. Why is that different? Who can explain that to me? Why do we have two different break even points that we can reference here? And this is a super, super important component when we're understanding, especially things like buying options. Because Chop says theta decay. That's exactly correct. This is where extrinsic value is. So the reason why this matters so much is because people will mistakenly move away from buying options because they think that they're going to have to get a stock to 53 in order to make money. But that's only accurate if you hold that option until all right, I think we're back. Yeah, it looks good. I don't know what that was. There's been a couple of those so far since I've been back from traveling. I don't know what that's all about. Okay, the next one. Which of the following represents the maximum potential loss for a naked call? Unlimited, stock going to 0, premium received, or strike less premium? Kirk says A. Any other guesses? Chop says D. So we got one here. We got one here. We need a tiebreaker, obviously. Crypto says A. Lauren says A. I think we have a clear trend. So let's check out A. Bingo. So for Chop, in this context, I think that you are confusing this with break even. Because that's what this is for a short, well, really a short put, I should say. This isn't, this would be for a short call. This would be this stock strike plus the premium. So if it's a put, if this is a short put, then it would be strike minus the premium. But all of this is the break even anyways. This isn't max loss. So when we look at a hockey stick diagram for a short put or a short call, sorry, a short call looks like this. So what this means is as the stock continues to go up, your P&L technically isn't limited. Now, that's a theoretical component anyways, because technically speaking, there's a finite amount of resources on Earth. So what that means is, again, from a like actual practical perspective, a stock can't go up forever. It literally would come to a point where it's consumed all of the value on Earth and it can't rise anymore. So if you want to be really, really specific, it's not unlimited. It's the same thing when we say a short put. When we say a short put, a lot of times we'll say it has an unlimited loss potential. But again, a stock can go to 0. So when we say unlimited in these contexts, it really is to substitute significant, highly significant potential. All right, next. Which market condition is most favorable for a buyer? Period just before expiration, stagnant sideways, low IV, or high IV. This is a fun one because I view this one potentially has two answers. So let's see. Ben says low IV. Kirk says low IV. Chop says low IV. Okay, so we have our trend. Let's see. I had a sneaking suspicion that people were going to get this wrong. And the reason why most people get this wrong is because of Tasty Trade. And it's because people have gotten too used to hearing the mantra of you buy when IV is low. And when I say buy, I mean premium. And you sell when IV is high. And as I've said before, and I'll continue to say again and again, this is inaccurate. It's a completely fine shortcut way of thinking of things, but low implied volatility is effectively the same as a stagnant sideways market. It's effectively the same thing. So in this context, when you're buying options, you need the thing to move. So even though they're more expensive to buy, they're moving. It doesn't matter if you get something cheap. If you get it cheap and it doesn't move, you lose. If you buy something expensive and then it moves, you win. So this is a really, really common misconception by traders because they're not putting first things first. They're putting secondary factors before primary factors. In this case, the primary factor is something moving. The secondary factor is, of course, we would want to get it cheap. We wouldn't want to pay as much for it. We definitely would want to get it a little bit cheaper. So that's okay as well. Chop says, but if you had it cheap and it moves, then IV will be high. Because as soon as the thing itself moves, IV is going to be higher. So the optimal scenario would be to get something in a high IV that has relatively low IV priced into the options. But that is a bit of a unicorn scenario. This was a great question. I'm really, really glad. And I'm also really stoked that it picked D. Because if I was guessing, I honestly would have guessed it also would have said C. So I'm actually happy that this one, I believe, is the correct answer that it also gave us. All right, let's see. Time decay, or theta, has positive effect on the position of an option blank and negative effect on the position of an option blank. So who knows? Who can help a brother out? Kirk says C. Ben says C. Sheet says C. Okay, so we have a trend. Click. Everybody says C. Good job. That's exactly correct. Seems like you guys know this one. Nothing to go into. Good job. Next. An investor has a strongly bullish outlook on a stock. Which of the following strategies offers limited risk and unlimited profit potential? This is a completely good question. What do you guys think? Strongly bullish outlook on a stock. Limited risk, unlimited profit. I see BBC. Ha! BBC, BB. I like BBC better. That's just a way better sequence of responses. So maybe we just repeat that. So I see 1, 2, 3, 4 for B. And then I see a C. So let's see. This is the majority. So why is this? Limited risk, unlimited profit. So because of this, this automatically forces us into long options right away. Limited risk, unlimited profit. It immediately gets rid of the sell choices. Then we have two choices left: puts or calls. And we know the relationship between these. Calls appreciate in value as the underlying goes up. Puts appreciate in value as the underlying goes down. So we said strongly bullish up. That backs us directly into this one. Okay, next. What is the primary advantage of selling options compared to buying them? Unlimited profit potential, less capital to initiate, profits from the passage of time, lower risk profile in all market conditions. What do we think here? I see a C, C. I'm seeing mostly C's. Got to do a little bit of a reload here on the seltzers. You guys know how that goes. We have the Mandarin Orange. Okay, so it's C across the board. You guys are correct. That is C. Now, if we wanted to make an argument that it has lower risk, how could we make that argument? It objectively doesn't, but it does have a element of lower risk. So what is the element of lower risk that we could argue if that was an answer? So let's say instead of D, it says lower risk profile in all market conditions. If that said it has a lower risk profile in some market conditions or in few market conditions or something like that. How might it help us to reduce risk? Think of it this way. Ben says you can also modify, manage, roll short premiums. Arguably, you could do that for long stuff too. That's another really common misconception, actually. It's a good guess. But you can absolutely roll long options as well. I actually do it pretty regularly. Kirk says define risk of downside to zero. I guess I wouldn't use that one personally. Chop says because you win going up or staying flat. Well, we're also, just to be clear, this just says selling options. This doesn't say selling calls or selling puts. It just says selling options. So this is under the context of selling either. Think of what one of the benefits of selling options is. Why would we accept something that has defined profit potential and undefined risk, whether we sell a call or put? Ben says cash up front. Not quite. If I sell a call, and let's say that the stock is at 50, the example from before, and I collected $3. What's my, there you go, Chop's on it, and Mikhail is on it. So what this means is if spot price is at $50 and I sell a $50 short call and I collect $3, even if this thing goes slightly against me, let's say it goes from 50 to 52.5. This has gone against me 5%. I've had a decent sized move relative to the overall position. Had a decent sized move against me. Yet, this is still a full profit at expiration. So in this case, the way that we can argue it has a lower risk profile in some market conditions is that it literally gives you a wider net to actually make money. So in general, they're higher probability plays. Not always, it obviously will depend on how you structure stuff, but in generalities. All right, last two questions. A trader sells a put option with a strike of 100 and they get $5. The stock drops to 90 at expiration. What is the outcome for the this is a good question. Who can do that math? Pretty easy. Ben says C. C. Also C. Okay. We have a trend. Good job. This one's super easy. All we're doing is first taking the difference. We have a short put. So we're taking the difference between strike and spot. So we have the 100 strike. Spot price goes down to 90. That gives us 10. We obviously multiply that for a one lot to get our $1,000 loss. But we collected $5. So we take away, we add that $500 that we collected, and that gives us a total loss of 500. Good job, guys. Next, last one. Buying an option gives you leverage, while selling an option allows you to trade with higher potential for gains, no risk of assignment, defined and limited risk, higher probability of profit. I see D. What other guesses we got? D, A, C, D, A, C. Oh man, we're all over the place. Oh no, I counted you twice, Chop. You gave me A twice. Anybody else? Okay. Kale says C or D. You don't get to do C or D. You got to pick one. Sheet says D. Got another D. All right. Exactly correct. It's exactly correct. The reason for this is, again, selling an option does not define or limit your risk. Remember, whenever you sell an option, you have undefined risk. So if I sell a call, my payoff diagram looks like this. If I sell a put, it looks like this. This is the unlimited element. This is the undefined element because it is undefined. That's absolutely correct. It's not defined. Whereas if I buy a call, looks like this. And if I buy a put, it looks like this. So notice how these have flat lines under the losses because it's defined. It's limited to whatever you paid for those options. When you sell options, it's undefined. You don't know what the loss is going to be. That's a pretty good job. I'm also going to start using Gemini for these. This is great. I love that it actually no shit builds a quiz that we can take this way together. That's, I think, a really, really fun way to do those. I thought it would be a fun little preamble before we get into the actual meat and potatoes for today, which is this. So we actually just talked a lot, actually, and indirectly covered a bunch of the stuff from this, which is really sick. So let's just kind of break down some of the fundamental differences between these. If we buy options or buy premium, you'll hear that used synonymously. These are your entry and exit transactions. This is literally what's going to happen when you enter the trade. So when you buy options, you are going to pay upfront for them. The money is going to leave your account. When we sell premium, you collect a credit upfront. That's the opening transaction. Exiting is just the opposite for each respectively. Now, we literally just talked about the risk profiles for these, for buying and selling options in terms of risk and reward profiles. We talked a little bit about the break-even points. So the big difference between buying and selling premium is that when you sell premium, there is a little bit of a buffer. You'll notice that as we go through these, that there is a natural balance to things. There literally is a natural balance as we go through these, which is the market's way of essentially saying one of these is not directly better than the other one. It can't be. Because if it is, nobody is going to take the other side of the trade. Why would we? If one of these is structurally better than the other, there is nobody on the other side of the trade. We're not there. So this is why it is such a common misconception. This is primarily by sellers. Premium sellers, typically at some point in their trading journey, they fall under this massive, massive illusion that selling is better than buying. It objectively is not. There's nothing that makes selling inherently better than buying. Which is why when we talk about trading options so much, you always hear me talk about these kinds of things in the context of what they are. What I mean by that is there should never be a point in your trading career where you say something like, I'm an options seller. I'm an option buyer. I'm an options trader. I am an index trader. I am an iron condor trader, so on and so forth. You get the point. What I'm expressing there is that your job as a trader is to do whatever makes sense for your portfolio and your objectives at the time. That's it. That's your fucking job. So sometimes that might look like buying premium. Sometimes that might look like selling premium. It's entirely up to what you're trying to do and what fits the best. So a couple other things that are worth touching on very quickly is the relationship between volatility, because that quiz did not talk about it, and it is quite important. So when we buy premium, if volatility goes up, we get helped. This is typically why people will hear the saying, if IV is low, you buy premium, which again is wrong. That's not something to completely hang your hat on. Functionally, it's absolutely correct. If you buy cheap premium, cheap vol, and then the thing goes up, yes, you will absolutely make money. But you'll also make money if you buy expensive vol and it goes higher. The thing that people are typically citing is reversion, which is a completely accurate citation. So what that means is when we see volatility at different levels, it absolutely has a propensity to come back to some sort of midpoint. So let me go to Palantir. I'm just grabbing a stock that's top of mind. And let's take a look at vol. I'm going to get rid of the other vols. We're just going to look at 30-day vol. If I plot a line of best fit we will absolutely see a propensity for this thing to move about a line of best fit. And there is a massive, massive difference when we're talking about mean reversion with respect to price and mean reversion with respect to volatility. The way to think about true mean reversion is that it's like a magnet. It pulls things back to a certain level, which is completely different. So if I take a look at vol itself instead of implied volatility percentile, and again, we draw a line of best fit around whatever the average vol is, we will see that exact concept play out. The reason why this happens is because volatility is a completely different function than other things like price. And here's a great visual to help you with this. If we take a look at two different names side by side, we'll look at a vol product and then we will look at price. We're going to look at SPX and VIX because they're effectively the same language. We're going to look over the last 5 years. Do you notice the difference as we look at this? If I look over the last 5 years, the middle of the linear regression, or these are standard deviation channels, the middle goes from 3465 to 5800. 3465 to 5800. This is the SPX 5-year. If I look at the VIX 5-year, let's see what we see. We start at 23.33 and we go to 16. What do you notice about the difference here? And this is during a relatively short window. The difference that you see in VIX is literally less than half of the total move. Just take these as absolute values. It doesn't matter if it goes up or down. We're just looking at the total values. Now, if we look at high-low range for another comparison, the high here is 65.08, the low is 32.09. Let's zoom this out further. What you'll notice is if I go out long enough, this is going to the inception essentially of VIX. What do we notice? The midline here of the standard deviation channel is like 2067 from the starting point back in 1986. And today, using the long-term average, it's like 1850. So this is in such a tight range. This is volatility. This is mean reversion. As this thing gets extended to the upside or downside, it is magnetically pulled back to whatever that average is that does drift. But you'll notice that when we look at something like SPX, that doesn't happen in the least. Even if we go back just to 88 here and we look across this time frame, that doesn't happen at all. So that's a key difference between price mean reversion and vol mean reversion. And that's why when we talk about volatility, it's super, super important to understand the broader context. Because when we're saying vol is high or low, and then we should buy or sell premium based on that, that all comes from the assumption of mean reversion of vol. The problem with that is that you'll notice that the mean reversion of vol takes a long time to occur. So if we take a look again at different windows, we see different levels of variance. If I look across the past 1 year in VIX, we have a range of like 1850 and 1950, about $1 range. But then as we just looked over the last 5 years, that was actually a much bigger range, 23 down to 16, and so on and so forth. So the summary for all of that is that it's really important to understand how your option will behave with respect to changes in vol. And when you're buying, it's really important to avoid overpaying. And when you're selling, it's really, really important to do your best to avoid selling when things are too elevated or too low, I should say. Sorry, when they're too low. But that being said, those are secondary factors. The primary factor is whatever you are trying to accomplish first and foremost. That is essentially these first two bullet points together. So we can essentially get rid of this one in its entirety. Because when we're talking about portfolio fit, that's effectively what's wrapped in there. This is the next most important factor, is what is the profit mechanism and what fits the idea better. And actually the quiz that Gemini gave us did a good job of elucidating this point. Because the quiz from Gemini says, if we're really bullish and we think something is going to move a lot, what might we do? A completely reasonable question. So what might we do? If we're really bullish, we're probably going to buy an option. Because if we sell an option, we might make money, but we could have made way more if we had bought. The last thing I want to talk about with respect to buying and selling options is the disease of win rates. One of the reasons why option sellers become convinced that selling premium is better than buying is because they experience typically higher win rates. The problem with that is that those higher win rates obfuscate what's actually making more money. So one of them can win a lot more frequently, but that does not mean it makes more money. They're different things. So if we take a look at S&P 500 buy rights index, what is it? BXM? BXM. So if I look at BXM's performance over different timeframes, we'll see different relationships. But if we look at any sort of significantly long enough periods, you'll see a really, really important trend, which is the buy right index, generally speaking, massively underperforms the index itself. Why is that? It's because something like the S&P 500 typically exhibits positive drift, meaning it's going up. So if we are constantly capping the profit side of our equation by selling calls at 1-to-1 ratio against our long equity, we're bound to underperform because we're not actually capturing the upside profit potential in its entirety. So most of the time, when traders believe that selling is better than buying, it's because they are completely misled by the high win rate. It confuses them, it misleads them. And it's because it feels good to win a lot. They want to be misled. I come across this a lot when I'm working with people on studying and conducting different analysis of their trading approach. And when I'm having these conversations, typically via Zoom, so I can actually see what we're doing, more often than not, what I find is people have a lot of scar tissue when it comes to even conducting general analysis, where we essentially try to see what we want to see. So if I'm trying to prove a strategy out, most people approach that problem set trying to prove why the strategy works to themselves. That's the wrong approach. That's the wrong scientific approach, just as you were taught in middle school. When we're studying things, our job is to create a study and see how it behaves. Then make inferences off of the observation. Because what ends up happening is it's the same thing here. When you have somebody that wins a lot, they're frequently winning. They want to believe that, and they want to believe that that's good, and they want to believe that there's some utility for what they're doing. And that's why they tend to convince themselves that they're somehow performing really strong or outperforming the market. But the reality is it's simply not the case. And it's because of expectancy. There's a balance to the scale, and there needs to be, because if the game was won by simply selling premium on different stocks, again, who wouldn't do that? It would be completely illogical to not do that. Yet, you'll find most professionals don't do that. The reason is most of us look at the game long enough and we become way less concerned with some sort of really sexy looking win rate. And we care about expected return, which, as all of you know, I have a couple different strategies that I cite to you pretty regularly that helps us understand this concept. So for a several month snapshot of one of my long call strategies, I'm looking at it in the log right now. The win rate is 46.3%. So that means I'm losing over half the time. Yet, I have a positive P&L and a positive average return and a significant skew in the typical trade performance. So this is a really, really important function to wrap our minds around, because if we fail to do that, if we don't learn to accept some sort of balance between risk-reward ratios and expected returns, we're kind of out there lost. Kirk says agreed, but there's data on risk-adjusted return of BXM versus SPX. BXM won't have as much vol. Sure. No debate. There's a trade-off for everything. There has to be a trade-off. Again, if I'm going to sell calls and cap my upside, of course I expect there to be a benefit. It's not going to outperform the underlying. So then what is the benefit? The benefit is absolutely a lower vol. So the underlying factor there is really kind of important to differentiate and just always go back to the fact that there's always going to be trade-offs. Kirk says BXM Sharp is 0.22, 0.22, SPX is 0.12. I'm not sure what study that is, but the other thing is I wouldn't use Sharp. Sharp is another thing that a lot of people mistakenly use because it's widely used in industry. But Sharp penalizes upside volatility. Sharp is measuring total vol up and down. I would care way more about Sortino ratios, because Sortino ratios really emphasize and track bad volatility, downside, not downside in terms of price, but downside in terms of P&L. I care about that way more than penalizing something that measures and penalizes total vol. So for Lauren, who's asking what is Sharp, the way to think about Sharp and Sortino is they're analyzing the volatility of your P&L. So Sharpe is looking at the total volatility of P&L, upside and downside. That means positive P&L and negative P&L. Sortino says, I'm cool with green P&L volatility, meaning I don't care as much if I make $1 or make $1,000. As long as it's green, I'm okay. And Sortino will track the downside. Kirk says 7.71 Sortino for BXM, 0.5 for SPX. And that's right there the beauty, right? Notice how small that becomes. Before, when we were looking at Sharpe, it's almost double. But now when we look at Sortino, it's like a third, if that. Because again, I don't know the study that's being looked at, and the methodology behind it is always of interest to me before I would take it at face value. But those relationships make sense to me. Those intuitively seem logical. So Kirk says Gemini told me. Yeah, see, that's the rub. Cannot take that stuff at face value, because that'll also be based on some sort of time frame. And it's always important to look at the source data from those. But again, that being said, I think it's close enough. I think those relationships make sense. I would expect to see a really bad Sharpe relationship between a covered call or a buy right strategy against buy and hold. That is intuitively, that makes sense to me. The other element is, notice how small that gap becomes though when we move to something that's only penalizing downside vol. Because the other thing that I think is an unfair comparison when we just straight look at buy right versus something like buy and hold is that buy right has an activity level to it, right? So that's also going to have a realized P&L drag via the realized returns, right? You're going to pay taxes on those. And if we want to go without some sort of tax footprint, then there should be another comparison, which you will find will blow the doors off of buy right, which is dollar cost averaging. Smashes buy and hold, and it smashes buy rights, because dollar cost averaging helps a lot with mitigating total negative P&L vol. So taking that all the way out to buying versus selling premium, the overall takeaway is don't be a one-trick pony. One is not better than the other. They all have their uses. The main thing is to do your absolute best as a trader to determine what fits the best for what you're trying to do. As always, if you have any questions, let me know. Be an outlier. See you guys later.